There is a particular kind of silence that follows a losing trade. Not the silence of peace or reflection, a heavier silence. The kind that sits in the chest and makes ordinary things feel distant. The phone is there, the room is the same. The world outside is continuing exactly as it was before the trade was opened. But something has shifted internally in a way that is disproportionate to what just happened financially. $100 lost does not rationally justify the weight of that silence. Neither does 500 or 1,000, at least not in the abstract. But in the lived experience of someone who has been trading for any meaningful period of time, the weight is not proportional to the dollar amount. It is proportional to what the loss represents. Another entry in a ledger of failures that is beginning to feel permanent. Another piece of evidence against the belief that this is something that can be figured out. Another small erosion of the confidence that brought the whole endeavor to life in the first place. The journey from that silence to consistent profitability is not a straight line. It is not a story with a clean turning point where everything suddenly clicked, and the losses stopped, and the wins began. It is a longer, messier, more incremental process than that, and the first honest thing to say about it is that most people who attempt it do not complete it. Not because they lack intelligence or analytical ability or access to good information, but because the process requires a specific kind of change that most people are not prepared for when they first sit down at a trading screen. The change is not in strategy. It is in the person applying the strategy. In personal change, genuine change in the patterns and responses that govern behavior under pressure is among the hardest things a human being undertakes in any domain. In trading, it is undertaken under conditions that are specifically designed by market dynamics to make it harder. Conditions of financial pressure, of real-time feedback, of the continuous presence of outcomes that carry emotional weight. The difficulty is not incidental. It is structural, and understanding that the difficulty is structural rather than personal, that it is not a reflection of individual inadequacy, but of the genuinely challenging nature of what is being attempted, is the first shift in perspective that makes completion of the journey possible. What follows is the complete account of that journey, described with the kind of honesty that the trading education industry consistently withholds, because honesty does not sell as well as the promise of simplicity. The losing phase, the transitional phase, where the real nature of the problem becomes visible. The construction of an approach built on sound principles rather than hopeful ones. The behavioral work that makes the approach functional rather than theoretical. And the reality of what consistent profitability actually looks like and feels like, which is different in important ways from how it is imagined during the losing phase. The losing phase has a characteristic shape that is recognizable across different traders, different markets, different starting capital levels. It begins with early success. Not always, but frequently enough that the pattern is worth naming. The market provides some winning trades in the beginning, often through the simple luck of entering a trending market and riding momentum without any particular skill involved, or through the statistical inevitability that even random entries will produce some winners. These early wins create a specific kind of confidence that is more dangerous than ignorance. The confidence of someone who has been confirmed in a belief that they have an ability they don't yet possess. The early wins are not evidence of skill. They are the market's most expensive gift, because what they produce in the recipient is exactly the wrong relationship with risk. The belief that the intuition can be trusted, that the read on the market is sound, that larger position sizes are justified by the demonstrated ability to identify winning trades. The market then does what markets do, which is to produce conditions that are different from the ones that generated the early wins. A trend reverses. A ranging market produces false signals. Volatility increases or decreases in ways that the approach was not designed for, and the trader who has developed confidence in their ability to read the market encounters a reality that the early wins did not prepare them for. That being wrong in trading is not an occasional anomaly to be corrected with better analysis, but a regular feature of the landscape that must be managed rather than eliminated. The losing trades begin, and the response to those losing trades, the attempt to recover quickly, the increase in position size to make back the losses faster, the holding of losers past their logical exit points, because closing them feels like giving up, produces the pattern of account destruction that characterizes the losing phase for most traders, regardless of what strategy they are nominally following. The losing phase can last for months or years, sustained by periodic winning trades that provide enough positive reinforcement to maintain the belief that the approach is fundamentally sound and that the losses are temporary aberrations rather than symptoms of a structural problem. This intermittent reinforcement, the same mechanism that makes gambling psychologically compelling, is what makes the losing phase so durable. If the approach produced nothing but losses, the problem would be obvious, and the correction would come quickly. But an approach that produces random alternations of wins and losses, with the losses somewhat larger than the wins, due to behavioral asymmetry in how each is managed, can sustain itself for an extended period before the account is depleted enough to force a genuine reckoning. The genuine reckoning is when the journey actually begins. It is not the moment of maximum financial pain, though it often coincides with that. It is the moment when the honest question replaces the defensive one. Not what is wrong with the market, what is wrong with the broker, what series of unfortunate events produced this outcome, but what is wrong with the approach and, more fundamentally, with the decision-making that the approach is producing. This question, asked honestly and pursued seriously, leads to a set of answers that the losing phase consistently obscures. The losses were not primarily produced by bad strategies or bad markets or bad luck. They were produced by behavioral failures, by the specific, repeatable, identifiable patterns in decision-making under financial pressure that converted strategies that might have worked into strategies that couldn't work because the execution was undermining them at every critical point. Identifying those behavioral failures requires the kind of evidence that most traders never accumulate because they never maintain the records that would make the evidence visible. A trading journal that contains not just entries and exits and profit and loss figures, but the reasoning behind each trade, the emotional state at the time of entry, whether the stop was placed as defined before the trade was opened, whether the position size was calculated from the formula or estimated intuitively, whether the entry met every criterion in the strategy, or was a marginal setup taken because the market was moving, and the desire to participate overrode the discipline to wait. This journal, maintained honestly across a meaningful number of trades, produces a picture of behavioral patterns that is invisible trade by trade and unmistakable in aggregate. The stop that was moved 6 times in a row when the market approached it, the position size that quietly doubled after a series of wins, the entries taken on setups that almost but not quite met the criteria, always in the direction of whatever the market had been doing most recently. These patterns are the actual source of the losses, and seeing them clearly is the prerequisite for changing them. The strategy that works for the transition from losing to consistent profitability is built on a foundation of principles that are not novel, but whose implementation requires the specific kind of behavioral work that distinguishes traders who complete the transition from those who don't. The first principle is that every trade has a defined maximum loss, implemented as a hard order before the position is opened, and that this maximum loss is never exceeded under any circumstances. Not moved, not overridden, not suspended for trades that look particularly strong. Every trade, without exception. The second principle is that every position is sized from a formula that calculates shares or contracts from the defined dollar risk and the distance from entry to stop, producing a position size that risks a fixed small percentage of account equity regardless of any other variable. 1% or 0.5% or 2%. The specific number matters less than the consistency with which it is applied to every trade in every market condition. The third principle is that entries are only taken when the market meets every criterion in the strategy's defined rules. Not most of them, not all the important ones, every one of them. And that trades that almost qualify do not qualify. The fourth principle is that winning trades are allowed to develop according to a mechanical trailing process that moves the stop in the direction of the trade as it progresses, never backward, protecting accumulated profit while allowing the trade to run as far as the market structure supports. The fifth principle is that the trading activity is reviewed honestly after every session and comprehensively after every week, evaluating not outcomes but execution quality, whether the rules were followed exactly as defined. These five principles are the skeleton of the transition strategy. They are not individually unknown to traders in the losing phase. The stop-loss principle is in every trading book ever written. The position sizing formula is explained in every risk management course. The requirement for full criteria before entry is stated explicitly in every serious discussion of trading discipline. The trailing stop concept is standard content in technical analysis education. The journal review practice is recommended by virtually every experienced trader who has ever shared anything publicly about the process. The information is not scarce. What is scarce is the implementation, the consistent, unexceptional, day-after-day application of all five principles simultaneously, without the modifications and exceptions and creative reinterpretations that the emotional self generates under the pressure of live markets. The gap between knowing these principles and implementing them is the entire challenge of the transition, and it is not bridged by learning the principles more thoroughly. It is bridged by building the structures that make consistent implementation possible, despite the emotional pressure that live trading creates. Those structures are practical and specific. Automated stop orders placed immediately when the position is opened, before the trade has moved far enough to create emotional investment in the outcome. A position sizing calculator, even a simple spreadsheet, that produces the correct share count from the formula, rather than requiring mental arithmetic under time pressure that the emotional self can influence. A pre-trade checklist that requires explicit confirmation of every entry criterion before the order is placed, creating a documented record that makes bypassing the criteria visible rather than invisible. A maximum daily loss figure that triggers automatic shutdown of trading for the session when reached, enforced through account rules, if the platform allows it, or through a personal protocol that is written down and committed to before the session begins. These structures do not eliminate the emotional responses that live trading produces. They create barriers between those responses and the trading decisions that prevent the responses from directly producing the behavioral failures they consistently generate when no barriers exist. The process of building behavioral consistency in trading is not linear. There are sessions where every rule is followed correctly and the results are poor. The stops are taken cleanly, the position sizes are correct, the entries are disciplined, and the market simply doesn't cooperate with the setups in a way that produces winners. There are sessions where the discipline holds under pressure in ways that would have broken earlier in the journey. A position approaches the stop. The impulse to move it is present and recognized and not acted on. The stop is hit, the loss is taken cleanly, and the session continues to the next setup without the emotional escalation that previously would have followed. Those sessions, not the winning ones, but the ones where the discipline holds under genuine pressure, are the evidence that the transition is actually occurring. Because the transition is not primarily a transition in results. It is a transition in behavior. Results follow behavior, not the other way around. And the trader who is building behavioral consistency before the results reflect. It is further along in the genuine journey than the trader whose results look good, because the market has been cooperative, without the behavior having fundamentally changed. The market conditions that the transitioning trader encounters are not uniformly favorable to any strategy, and understanding how to respond to different market environments without abandoning the framework is one of the more nuanced aspects of the transition. Trending markets, where the framework's edge is strongest, produce the kind of sessions where entries at pullback levels generate clean moves in the expected direction. Stops are moved to break even quickly, and some trades develop into significant winners that validate the patience required to wait for proper setups. Ranging markets, where the framework struggles, produce sessions of repeated stop-outs as price oscillates around the entry levels without developing a sustained directional move. The response to ranging market conditions is not to modify the strategy to work better in ranges. It is to recognize the ranging environment through the objective criteria that define it, reduce trading activity in the absence of clear trend confirmation, and accept that some periods will produce flat or slightly negative results as the cost of maintaining the framework's integrity for when trending conditions return. The trader who modifies the strategy every time it encounters an unfavorable environment never allows the strategy to demonstrate its edge in the favorable environments, because by the time those environments arrive, the strategy has been changed into something different. The account growth that comes from consistent application of this framework is not dramatic in any short period, risking 1% per trade, with an average winner of 2% and an average loser of 1%, with a win rate of 45%, which represents a genuine positive expected value, produces a monthly return that would be considered unimpressive by anyone in the losing phase who is imagining what consistent profitability looks like. The accounts that double in a month in these strategies are accounts where the risk management has been abandoned and the leverage has been increased to a point where the distribution of outcomes includes both doubling and losing everything with roughly equal probability. The accounts that grow steadily, month after month, with controlled drawdowns and no catastrophic losses. Those accounts belong to traders whose monthly percentage gains are single digits in most months, and who find that unexceptional because they understand that compounding of single-digit monthly returns over years produces substantial absolute wealth, and that the alternative, chasing larger monthly returns through increased risk, produces the kind of variance that makes sustaining the approach impossible over the full cycle of market conditions. The psychological shift that accompanies the transition from losing to consistent profitability is as significant as the strategic one, and in some ways more important, because it is the psychological shift that makes the strategic consistency possible. The losing phase is characterized by a specific relationship with the market, a relationship of adversarial dependence where the market is simultaneously the source of potential salvation and the entity responsible for the financial damage being sustained. Every trade is emotionally charged, because every trade is carrying the weight of the need to recover previous losses and the fear of adding to them. This emotional loading of every trade makes disciplined execution nearly impossible, because the stakes feel too high for any individual trade to be treated as one data point in a statistical distribution. It feels like a referendum on the entire endeavor, on the competence of the trader, on whether the whole thing is worth continuing. The transition produces a different relationship with the market, one where individual trade outcomes are genuinely less important than the quality of the execution process. This shift happens gradually, through the accumulation of evidence that the process works even when individual trades don't, through the experience of taking a clean stop, and then watching the market continue against the position, without the emotional devastation that would have accompanied that outcome earlier in the journey, because the stop being taken correctly is evidence that the process is working, rather than evidence that the strategy failed. When a losing trade is the result of correct execution, entry met all criteria, stop was placed as a hard order, position was sized correctly, the stop was hit without being moved. It is a different kind of loss than a losing trade that resulted from rule violations. It is an acceptable outcome rather than a failure. And when losses are acceptable outcomes rather than failures, the emotional system's response to them changes in ways that make the next trade easier to execute correctly. This recalibration of what success means on a trade-by-trade basis is not something that happens from understanding it intellectually. It happens from the accumulated experience of executing the process correctly across enough trades that the connection between correct execution and long-term results becomes experientially real rather than conceptually understood. The journal is where this connection becomes visible, where a trader can look back across 50 or 100 trades and see that the trades executed with full discipline produce the results the strategy's edge predicts, while the trades where rules were bent produce the outcomes that behavioral failure reliably generates. That visibility is the foundation of the confidence that consistent profitability requires. Not confidence that any particular trade will win, but confidence that the process produces the results it is designed to produce when it is followed correctly. Consistent profitability, when it arrives, feels different from how it was imagined during the losing phase. It is not accompanied by the elimination of losing trades or the resolution of uncertainty or the disappearance of the discomfort that financial risk creates. Losing trades still happen. Losing weeks still happen. There are periods where the market environment is genuinely unfavorable, and the strategy produces flat results for extended stretches. The difference is not in the experience of individual sessions. It is in the trajectory over time, which is clearly and consistently upward, in a way that reflects the genuine edge being applied with genuine discipline, rather than the random variance of an undisciplined process. And the difference is in the relationship with that trajectory, the ability to see a losing week without catastrophizing, to see a winning week without increasing risk, in ways that put the gains at risk, to see the whole thing as a long-term statistical process, whose short-term fluctuations are expected and manageable, rather than as a series of individual high-stakes moments, whose outcomes determine whether the entire endeavor was worth attempting. The strategy described in this piece is not a proprietary system. It has no name, no trademark, no exclusive methodology. It is the application of sound principles: trend alignment, structural entry, hard stops, percentage position sizing, mechanical profit protection, honest review, to the specific challenge of retail trading in financial markets. What makes it effective is not that its components are unique, but that its implementation is complete, consistent, and maintained through the full range of conditions that market participation produces over time. The trader who applies it partially, who follows the entries but not the stops, who uses the position sizing formula in normal conditions but abandons it during high-conviction trades, who reviews performance only after winning weeks. That trader does not have this strategy. They have a collection of concepts that will not produce its results, because results come from the complete system, not from the components in isolation. The journey from losing trader to consistent profit is available to anyone willing to do the work it actually requires. Not the work of finding the right strategy, which is the work the losing phase imagines is necessary, but the work of building the behavioral consistency that makes any sound strategy produce its theoretical results in practice. That work is ongoing, not completed at any single point, because the market continues to produce conditions that test the discipline, and the conditions under which behavioral failures occur are never fully eliminated. They are managed, contained, responded to correctly, with increasing consistency over time. But the trader who is genuinely on that path, who has identified their behavioral patterns, built the structures to address them, maintained the discipline to follow the framework through losing stretches, and accumulated the evidence that the process works when followed correctly. That trader is no longer in the silence that follows losing trades. They are in a different relationship with the market entirely. One where the question is no longer whether profitability is possible, but how to maintain the process that produces it across whatever conditions the market presents next.